And Larry Summers is in Mumbai today. Let's go straight across to him.
A term that had been used in the 1930s by the great American economist, the economist who more than anyone else imported Keynes' ideas into the United States, Alvin Hansen. That term was secular stagnation. Secular stagnation was not a forecast, it was a fate to be avoided. But by using the term secular stagnation, I was attempting to highlight what seems to me to be a defining part of the challenge economically in the industrial world, which, as I'll discuss, in turn has implications for the developing world. And that is that for a variety of reasons, the propensity to save is high relative to the propensity to invest in the industrial world. That there are a large number of people who want to save for a rainy day, or save for their children, or save for their retirement. And that there is a limited number of capital investment projects that can absorb that saving. Of course, in a market economy, there's a price, and that price tries to bring supply and demand into equality, and that price is the interest rate. And so, if one looks at interest rates, they are at extraordinarily low levels. As we literally speak, short-term interest rates in the United States, Europe, and Japan average 0. If one looks at long-term real interest rates, as inferred from index bonds in the United States, Europe, and Japan, the average is 0. That suggests that there is some kind of excess of saving over investment. If one accepts this hypothesis, that there's an excess of saving over investment, it helps to understand another feature of this moment, which is that we have such substantial lowflation or deflationary pressure. Prices nowhere. There are inflation swaps, basically ways that financial market participants can bet on the rate of inflation over the next 10 years. Nowhere in the industrial world is inflation expected over the next decade to be as high as 2%. And of course, we are seeing sluggish growth. Growth for the United States over the next few years is, on the current policy trajectory, expected to be 2% at best, and perhaps a bit less than that. And that is a generous estimate relative to anything that is anticipated for Europe and Japan. In the context of a world with a chronic excess of saving over investment, some other troubling things start to become explicable. Think about the period between, say, 2003 and 2007 in the United States to start with. It was a period when we had adequate growth. We didn't have a recession. The economy was growing. Nobody would call it spectacular growth. Nobody would suggest that the economy was in severe danger of overheating or having huge inflation. And yet, think about what was going on in that period. We had the Bush tax cuts while we were fighting the Iraq War. We had extraordinarily easy monetary policies. We had what people look back and say is the mother of all credit bubbles. And we had a massive bubble in housing prices. And all of that was only enough to produce adequate growth. Japan didn't have adequate growth during that period. Europe did have adequate growth, but it rested on an unsustainable financial foundation of large flows of credit from the north of Europe to the periphery of Europe. So the history has been adequate growth, but not financially sustainable growth, financial crisis, and very weak recovery. And that suggests that it has been a long time since things have been as they should be, and one can simply rely on prudent turning of the dials of monetary policy.
All right, so that was Larry Summers there speaking on various economies and the role of central bank and inflation targeting that is being done by most of the central